Well, we've been waiting for the stock market to top because the technicals have told us this is the biggest bubble in stock market history that ended early this year. From 2009 to then, 15 years of massive multiple upside caused by monetary policies. We know QEs lasted for, we had free money for 10 or 15 years. And even when they raised rates, it was lower than it had been in 50 years. So, it was free money. Okay. When you have free money, it goes somewhere. And it went into the stock market. Investors now are deciding maybe they don't want it there. Okay. And yes, the guys who claim, and there's many of them, and analysts and investors, that when the stock market goes down, so does gold. They're too much focused on a narrow event, a brief period of time. The last time where this occurred, and they still remember it, is that October of 2008. At that point in time, gold had already been rising since its lows in price. In the year 2000, 2001, it was about $260. It went up all the way to 1,000, okay, quadrupled. And that was before that collapse in the stock market. And in fact, part of that was while the stock market had already topped and was headed down. The stock market had been dropping for a full year, and gold's still rising. But in the summer, especially in October of 2008, the stock market finally had a sharp drop within the context of what was already an ongoing bear market. It dropped like 30% in a month, okay, October of 2008, a year off the high. At that point, gold said, I'm going to correct too. I'll use this as a correction opportunity. And it had a collapse down into the 600s. And people think it goes with the stock market. Gold is a monetary metal. It is the inversion of the ongoing collapse in the real value of paper money units. Yens, euros, dollars, you name it. They always depreciate because governments always expand the money supply. They create free money, artificially low price of credit, and it creates distortions. And gold is merely an ongoing reflection of the decay in the monetary units that we use. That's still going on now. Money supply is still growing. It basically doubles almost every decade. And when the Fed has an excuse or justification, which is what they were created for, to save certain institutions, banks especially, they push the pedal to the floor. Okay, and sometimes they back off a little bit, but then they push it to the floor again. Now, if you saw Powell today, he was comfortably smiling and talking about, we have these two mandates and the economy looks solid. Even the reporters in the audience were smart enough to say, yeah, but, when the stock market goes down, then the data points change. It's the point we've been making for many months. They don't turn first and then, the economy's getting worse, so the stock market goes down. No, the Fed is going to have soon all the data points they need to smack them in the face to, again, push the pedal to the floor. And I know they don't want to because, frankly, they don't like Trump. He doesn't like them, so there's an antagonism there. And so Powell's kind of smiling right now because the stock market's going down and he's not getting blamed for it by keeping rates too high for too long. Trump is getting blamed for it. So he's in perfect position. The problem is this, the banks. And look at an ETF like KBE, which is the major bank ETF. Look at Bank of America. Look at Citicorp. I mean, these banks are dropping enormously, far more than the S&P. In fact, over the last week, S&P would be down 3 or 4% one day, 3 or 4 the next. Banks would be down 6 or 8%, 10%, etc. And I'm not just talking 1 or 2, but the sector. Okay, that is a sector that few people are talking about for some reason. And that's the one that will provoke the Fed into panic mode and probably not even waiting for a meeting. So I think that's where we stand right now. And I think that is an underlying explosive ingredient for gold and for silver. And we can comment on that a little bit later if you want to talk about silver.
To stay ahead of the game and gain valuable insights into market trends, financial strategies, and expert analysis, don't forget to subscribe to our channel. By subscribing, you'll get real-time updates on key financial news and trends that could impact your investments. Join our growing community of informed investors and ensure you're always in the know with the best content on market dynamics and investment tips. Hit that subscribe button now and join the conversation.
Well, if you look at the mama market, gold, right now as we speak, it's trading 3.5%, okay, off of its high daily close, which occurred a week ago. But it's down 3.5%. Okay. Stock market was, look at, bank sector, stock market, and silver and commodities also going down because, we're going into a depression or something. Well, we might be, frankly. But there's a couple mistakes there. One is the assumption gold goes down with the stock market. Yeah, it could go down on a couple weeks here and there with the stock market in a sharp situation. But let's go back and look, for example, at that October of 2008 event. That's when the stock market had already been coming down hard for a full year and finally had a puke. Okay, and gold said, I need to correct anyway, so it had a puke. The Fed sat and watched the banking sector implode during the summer, and the Lehman Brothers went under in September of 2008. Stock market collapsed the next month, in October, and it wasn't until November that the Fed finally said, okay, we got to do something. They'd been cutting rates all the way down, but they did QE at that point. So right after that October collapse, a full month or two after Lehman went under, the Fed finally woke up, copied the Japanese model, and started doing QEs. November 2008. Stock market, by the way, went down for 5 more months into March of 2009, substantially further lower. But if you bought early in November, right after that October debacle, where you thought, stock's going down, therefore gold goes down, actually, gold stopped and turned and started to explode back to its highs within about 3 or 4 months, had gained from the 600s back to 1,000, like a 50% gain. Not because the stock market turned up, no, because the Fed hit the pedal. And that's what causes gold to move the way it does. Now, right now, if you look at Powell today, they're not going to hit the pedal. He's just going to be academic about it and wait for the data points. I mean, when the blood's in the street, he'll finally see the data points. I strongly suspect that the phone calls between the major banks and the Fed have been increasing at a tremendous rate over the last week or so. Because it's not just one bank, it's all of them. They're going down much harder than the stock market. So everybody's talking about, Tesla collapsed and Nvidia's down hard. Who cares? It's the banks that matter to the Fed. After all, the Fed is the banks, okay? Now, that's why gold's down 3.5%. Somebody's buying gold relative to the rest of the world. And I think that's because they see what's coming. The Fed has maybe learned a lesson since 2008 and learned, hey, we can't wait too long. We can't wait for an actual big bank to go under because then we'll look like idiots. We need to actually do a QE, start buying assets, start buying banking ETFs or whatever, bank stocks or commercial real estate, another implosion area, before it becomes a bloody headline. The silver-gold spread has been trying to break out, as has the gold miners versus gold, which when you plot the spread chart, and we do it like weekly in our reports, there's certain levels. If you could get GDX up to a certain level versus gold, it's going to break up a couple-year downtrend on the spread and say, okay, I'm back. Okay. Silver has a similar situation, and you're right, we're literally in the gutter historically in terms of price. So either we're totally wrong and silver is no longer a monetary metal, which I don't think is the case. And by the way, if you go back, for example, over the last year, for let's say March of 2024 to the close of last month, silver went up, the commodity index went up a slight amount, I think, during that year, a couple percent. Silver went up almost as much as gold on a percentage basis over that 12-month period. So silver was moving with the monetary metal, not with crude oil, which is laying, on the floor for the last year, or copper. It was behaving like gold. And suddenly for this week, it's not behaving like gold. I think that's a mistake. Silver is the little puppy on a leash held by gold, okay? And I think right now it is in a slingshot position. Yes, there may be slightly lower lows next week, but I'd be watching right now for any sign of an upturn. And there's another reason, technically. I used to keep point and figure charts. People, the X's and O's, where you get upticks, you get downticks. Silver never tops with a double top. Well, we made a high at 35 back in October. We had a drop down to 30. So you had 4 down ticks on a $1 chart. Then you went back up to what? 35 last month and this month. You put the upticks back on the board to 35. So you peaked at the same level you did last October. And now you've down ticked again to 30. Almost traded 29 today. I actually want to see it trade to 29 and take out that last low. So people then pull their hair out. So, oh my gosh, it's no good. Because on a point and figure, when you do that, you set up a double top and take out the column low. Pardon me if I'm being academic here. And then you start to uptick. What it was a bear trap low, meaning you went down and took out the last low to spook people. And if you don't sustain and you start to uptick, you're headed for a triple top breakout. And I think that's what silver's setting up here, is a compression situation where it flushes everybody out without the help of gold. I mean, like gold's only dropped 3.5% and suddenly turns and burns. And so I think watch gold. I don't think it's going to do what the stock market's doing or what silver's already done or what commodities have done. It's hanging in there pretty tough. And I think that says something.